Hello, folks. Welcome to the show. And today's guest, shall we say, is a financial markets participant. We have with us Vivek Bajaj from StockEdge. Vivek obviously has a kind of a long drawn career into the financial markets. He runs StockEdge, which is I would say, research and analytics platform catering towards retail investors. Obviously, Vivek has been, doing a couple of other things. His LinkedIn profile is fairly extensive, so I'd like the man, introduce himself. Hi, Vivek. How's it going?
All well, all well. Thank you for having me. So I'm a third generation financial market participant. My grandfather was a financial market trader. My father is a trader. He's 74, but he's still a trader. So, it's there in my blood. And that actually prompted me to become part of this industry. So it's been almost 15 years now since I've been part of this industry. I started my career as an analyst after my MBA in Bombay with JM Financials as a commodity analyst. And I didn't last there for long and came back to Calcutta and I started my own commodities trading. So if you remember 2006, 7, 8 was the golden period for traders to make money from the market. So fortunately timing was good and I was able to establish a base for myself. So from commodities, I moved to currency, which was launched in August 2008 or 2009, currency futures market. And then algo trading came in again 2009. So by and large, I have always been a trader and I have always adapted to new mode of trading. So as on date, as far as my trading desk is concerned, we have more than 200 associates part of the trading desk. So we do proprietary trading there. So that's my core business. That's where I come from. And I've been using tools like Bloomberg, Reuters, and other analytic tools throughout my life. I'm a big fan of Michael Bloomberg, and I love the thing which he has created, the way he has democratized the information in financial markets globally. So that kind of inspired me to do something similar for retail investors. So in 2013, I started this new journey of empowering retail investors. So the first point of the journey when it comes to retail investor is knowledge. I think 99% retail investors have very, very less knowledge about financial markets, the way it is taken care of, be it investing or on the trading side. So we developed this marketplace for finance education called elearnmarkets.com, which became the largest. As we speak, there are around 4.5 lakh learners who have learned from us the various aspects of financial markets. And also in 2016, we launched StockEdge as my vision of creating a Bloomberg for retail investor, something which should be very simple, very enticing and very effective. Something which was not there. There was an app by a media company way back and still it is there, but very cluttered, very heavy. So we thought that how can we simplify the access of data and analytics to retail individual investor. That's how we launched StockEdge in 2016. And as we speak in that product, we have almost 1.5 million download and almost 500,000 people are actively using it on a monthly basis. So all in all, the whole journey of empowering retail investor has taken almost 5 to 6 years to build that whole ecosystem. But now we are well positioned. And especially during the COVID time when more and more retail investors have come into the system, we are realizing that yes, our product portfolio have really helped people to become more independent and more aware about how they should handle the financial market, either on the trading side or on the investing side.
So this is very interesting. You mentioned in the end that with COVID, more and more retail investors are in the financial markets. I mean, there's naturally, been a kind of a Robin Hood trader theme playing out of North America, especially in the US. So you are seeing something similar here?
Well, Robin Hood, the problem is that
Obviously you don't want to say Robin Hood. I get that.
Yeah. So we all are using it with a negative connotation these days, thanks to, I think, media who has kind of overhyped the Robin Hood term. But yeah, I mean, you have to understand the characteristic of people who are coming. These are basically millennials, first timers who have never seen financial markets so deeply the way they are seeing right now. But having said that, there is a significant non-millennial population, people who are into some job or into some business, and they are finding time sitting at home looking at the market. They may not necessarily be the Robinhood traders, but people who are already there in the market. Let me just share with you some numbers. So if you see BSC website, there are around 5 crore plus KYCs in BSC. That means 5 crore plus investors, okay? And if you see the demat account, there were around 4.5 crore demat account now in India. But if you see the number of people who actively trade, that means probably once in a month, that number will not be more than 25-30 lakhs probably. And that too, thanks to discount brokers, that number has grown. Otherwise, that number was also not more than 15 lakhs or 20 lakhs. So the chunk of the population who have invested in market, who have some stock in their demat account, they were not active. And these are not many. These are people who already had demat account 5 years ago, 6 years ago. Most of the demat growth came to in India during the Reliance Power IPO. Almost 1 crore demat account we opened during that IPO, and most of these guys are dormant. They are not using their demat account. So these are not millennials. So I think in market, what has happened because of COVID is obviously new players have come in, which are millennials and more Robinhood guys. But then the older ones who already have stock in their portfolio, and now they're thinking what to do next in their career because their business probably is not doing great, their job is not secured. That population has suddenly come in as well, which is not Robinhood for me, which is a serious investor now looking to become an active investor.
And I was looking at some data as well. I think we're adding about 5 to 6 lakhs of investors on a monthly basis for the last 3-4 months, and this is CDSL data. So fairly, nice uptake in embracing investment, investing from the retail side. I get the StockEdge, and it's a real, value proposition that it offers your customers as well. And, being close to the trading desk in our lines, we also value those products and have the similar views on Bloomberg. Another thing that, people often in the Indian investment ecosystem complain about is, lack the quality of data that comes out, not from the company's level, right? Like there is and you can tie it with corporate governance as well, but the sheer quality of data that comes in is prevents a lot of investment, especially in the mid and small caps. How does StockEdge, or how do you view about that side of the market? Because that's even the multi-cap funds right now, the new norms, that's also trying to target the small cap sector. How do you, and it's a big problem, right? And how does StockEdge address something like that, or what are your views on that?
Yeah, so I'll classify this discussion into two parts. One is the intent of providing a wrong data by the companies. And second is that it just happened because of the process of collection of the data itself is a problematic. So the wrong data just came in. Company didn't have intent to provide the wrong data. Now, with respect to first part, obviously in India, corporate governance is an issue, and we all know that. Maybe regulator needs to kind of tighten the company's listing norms, and the company needs to be penalized very heavy for the wrong data. Because the whole process of data submission, if you see the departments of the company, listed company, so there will be a compliance department, which will be resorted with the responsibility of investor relationship. And these are the guys who will typically give the data to the exchanges. Okay. Now, most of the companies, the most underperformer in the company is actually made part of the corporate, of the compliance department. Why? Because this is not a creative department. It's it's kind of a regulatory compliance department which you need to keep. So you don't keep the best of the best talent there. So because of that, the quality of data which comes to the exchanges through corporate is also not very good. Okay. And even the process of collection data is a faulty. Companies submit PDF, and that PDF is getting converted into database by these vendors like Accord or Dion Global, and there are multiple vendors. Obviously, when there is a manual intervention of conversion from PDF to data, there will be an error. So, the whole process is so unreliable right now that there will be problems. Okay, so we'll have to live with that problem right now. But how StockEdge is solving is we are going back one step. We are saying that okay, this is the data we have received. Where is the problem with that data? Can we get similar data from other sources? Then we club both the data, and then we run machine learning and clean the data. And we try to arrive at a data which is most likely to be correct data.
Yeah.
Now we can't give an authenticity check that yes, this is the correct data, because if company is not giving you the right data,
Yeah.
obviously there is a problem. By clubbing multiple data sources and by cleaning the data through machine learnings, we are able to produce the most authentic data, which probably a genuine company is trying to produce.
But I mean, like, in terms of like, obviously you're looking at it right now from a product standpoint. Like, if we take a step back, in terms of you obviously flagged the point of corporate governance, as well as weak compliance departments within corporates having a role to play when it comes to bad quality of data. But where do you think the fix is? The fix is regulatory, or the fix is market oriented? I mean, in the sense, market oriented being like, liberalizing the shorting kind of regime to kind of ensure that there is a correcting mechanism and corporates, pay cognizance to that entire point, or is the idea to actually, have a regulatory kind of hit a hammer on the heads of corporates? Where do you see the fixes, or is it a mix of both?
I think both. I can't deny the role of both, because in India, regulation is required in everything, literally everything. So we are used to, that's the way our DNA has been, that if we are regulated, we actually behave properly. So yeah, so that is important. But I think the most important is the implementation of technology in this domain has been very slow. The corporate data or corporate reporting, there is a standard called XBRL, which was introduced almost 6 to 7 years ago. But if you see, the essence of the submission has not been met. If you talk to XBRL board, they will say that we are not satisfied with the quality of data companies are submitting, because the physical submission talks about something else and the XBRL reporting again talks about something else. So I think technology in this domain needs to be ramped up. The entire cycle, right from defining the taxonomy to connecting the corporate with the exchanges directly and asking them to submit in that particular format compulsorily. All these things will lead to production of quality data, and this is not something new I'm talking.
Yeah.
If you see in US, corporate data are much more reliable. Why? Because the whole cycle has been established very properly by the regulator.
Right. And, kind of looking at the markets overall, I mean, sure you have been, as someone leading a proprietary desk, as well as someone who has products which are deeply intertwined with the markets. Like, what's your take on things going on, in the sense that obviously we saw COVID. After COVID, there was a significant correction, or which kind of led to, I think, a lot of value propositions on the table. I mean, investors might think, and then there was a rally. Then we are again seeing things calm down a bit. There are multiple themes going on. There is an expectation of a return of a small cap and mid cap rally. There's also that entire theme that it's just that low interest rate environment has led to too much liquidity in the system, so the price doesn't really reflect the underlying value out there of stocks. And in addition to that, then we see Nifty hit 32, 33 times PE, which is again an all-time high. So, I mean, I want you to answer this question, obviously as a market observer, but also as a market participant. I'm sure you trade personally actively. You must also be having some sort of a school of thought when you are trading. How do you view the entire dynamic that we are seeing?
So the textbook definition of market is that it should always follow the fundamentals, and valuation is the reality of fundamentals, that whether it is expensive or cheap. Okay. Now, what I have realized over the last couple of years is that stocks, they follow fundamental valuations, but indices, they typically don't follow. Indices are more liquidity driven, because when a hedge fund manager is putting money on Nifty, the person is comparing gold, dollar, crude oil with Nifty. Okay. So it's a more liquidity which is driving the action in the indices than on the stock side. So when you talk about stock, obviously there will be some sectors which will be very expensive. There will be some sectors which will be very cheap. So that we all know that it is purely driven by the growth. So if there is a high growth sector, then obviously the stocks will be expensive. For example, FMCG. And there will be cyclical sector, then obviously those will not be expensive. So as a prudent market participant, I've actually started giving less importance to Nifty movement.
Right.
Yes, I do use that moment for timing my stock investments or stock trading. But beyond that, I don't make a judgment on market purely based on Nifty. I always believe in this theory of 10-10-10. That follow 10 stocks for a period of 10 months. Don't have more than 10% loss per month in your capital. That's the theory which I recommend to all freshers. That don't come into the market with keeping in mind that there are 6,000 listed stocks in BSE. No, you come to the market keeping in mind that there are only 10 stocks which you can understand, which is within your circle of competence. So I also restrict myself to around 20 right now. I started with 10, but now I have around 20 stocks in my portfolio, which I actively use to trade the market. Now each stock, because of their sector background, because of their business model, the price will behave uniquely. For example, market today is going down. Now out of these 20 stocks, 10 to 12 stocks are not doing well. And I'm happy about it because I've been getting an opportunity to buy those stocks at a lower level because I sold them at a higher level. So the moment you move out of that, Nifty क्या लगता है, Dow Jones को क्या हुआ सुबह, अभी क्या हो रहा है, you stop seeing media channels and you just focus on those 10 to 15 stocks. I think you'll be much more sorted and you'll live in a much more peaceful investing or trading life.
Yeah.
But I mean, on the flip side, the indexes do have an impact, right? I mean, directly or indirectly. I mean, one can't like that entire momentum does kind of play a role, and obviously, like what you were saying, plays well if you are looking at like a value thesis with some sort of a long term, horizon, kind of filtering for quality bets. But I mean, the entire I think that's something much more prominent in the US probably than in India, where this entire decade of low rate environment has led to asset prices just being inflated and not reflecting the fundamentals also to a certain extent. But do you see that risk also coming in the emerging markets? Because I mean here also, I mean when you look at like rates, that pressure is coming on the RBI. Fed has already delinked pure play inflation targeting with an average inflation regime. In India also probably that entire approach will get mirrored in some form or fashion. So do you see that risk playing out here as well?
I think if you see RBI, the way they have kept their targets in mind, inflation was definitely the most important component. But for them now to manage growth is also important, and there is obviously a political influence. RBI is not the same it was 2 years ago, right? RBI is very, very different because the whole monetary and the fiscal measures goes actually in tandem with current RBI. So to measure the growth or to keep the momentum of the growth, I don't see that they are in a hurry to increase the interest rate.
Right.
Okay. So that means in India also interest rate is expected to remain here and there, maybe 25 basis or 50 basis point we can see an increase. But there is no hurry on the part of the RBI because of government, because of other things as well. Maybe not because of inflation, because inflation will tend to go up. Okay, because of the base effect. Last year inflation base was low, so this year obviously we'll see inflation going up. But is RBI in a hurry to increase the interest rate? No. Under that situation, if we talk about cyclical sectors, which will get tremendous benefit out of this low interest rate regime. Let's go back to the period, say 2004, 2003, when interest rates were very low. Which are the sectors who actually led to the growth from 2004 to 2008? You have real estate, you have automobile, right? These are cyclical sectors which are highly dependent on interest rate scenario. So I see if we can identify sectors in this scenario and identify good quality stocks in those sectors, it should not be a very difficult task. I'll give you an example. I'm very bullish on residential real estate right now. Because whatever has happened bad with them, it has happened. There was RERA, there was a lot of negativity. For last 8 years, that sector is not doing good, right? And this is a time when home loan rate is only 6%. This is a time when people want to expand to multiple residential houses because of COVID, because of work from home. People need space in their houses. What will happen? Eventually, the residential market will recover first. And we are already seeing that. So these are the cyclical sectors one can look at taking benefit from these low interest rate regime.
And with the US's prolonged appetite towards keeping a low interest rate environment as well, do you see benefit to the Indian ecosystem in terms of some capital being deployed here, which relatively offers a higher rate? Is that would you keep that as a long-term theme that should help domestic equities over the next 2 to 3 years?
I think so. See, India is a very high beta country.
Yeah.
So, and the money which comes to India typically wants to get invested in equity, not in the bond market.
Yeah.
We don't get investors from outside because they are looking at a regular income generating country. We are a high beta, high growth country.
Yeah.
So a lot of money will come into India, and equity is going to be default asset class.
Yeah.
Otherwise, what are the other asset class? Either people will do FDI, so that will keep on happening because everyone wants access to the Indian consumer base, or people will do FIIs, which is direct equity investment.
Yeah.
Bond investment anyway, there is a cap by RBI, and no one comes to India for bond investment because we are not a superlative risk-free country where people would like to park their money.
Yeah.
I mean, and kind of it also, boils down to your earlier point on like bond investors require a certain amount of stability in the regulatory environment, a certain amount of stability in the corporate environment, governance becomes an issue, disclosures become a much bigger issue for bond investors.
And liquidity as well.
Yeah, so that entire, that lack of depth in the bond investors is a theme that we have been hearing for the last decade now. So that kind of, sits well with your point. You mentioned residential mortgages and residential real estate. I mean, that also kind of, one of the biggest themes which are also haunting Indian equity markets is sometimes the distressed banking sector, right? And obviously residential mortgages, residential real estate, thanks to COVID, thanks to work from home culture, probably there is the kind of a supportive tailwind to come in. But what about the other forms of lending or credit? I mean, do you look closely at financial stocks as well? Is that something that you would be looking at?
See, there is very limited NBFCs because there are so many NBFCs and everyone have their own unique model. But I do look at the consumer durable NBFCs who are very active on the retail side.
Right.
So I mean, Bajaj Finance is obviously leader there. So there I always see that there will be continuous demand because of the growth in consumerisms in our country. And we have just started in terms of consumerism because the propensity to consume is far, far, far higher than what we are doing. And in fact, we are witnessing that work from home automation, changing the whole environment at your home by incorporating a lot of electronic things. Everything is leading to increase in demand for the consumer durable goods, which will help NBFCs dealing in that particular segment.
Yeah.
Apart from that, not very sure about the microfinance businesses where most of the NBFCs are because they have their own challenges because that is highly dependent on the core economic slowdown.
Right.
And at a ground level, yes, there is a slowdown. People are closing their business. People don't want to do business anymore. How will they recover money from those business-oriented lending? I don't know. Yeah. But collateral-based lending is fine. I mean, if you have housing loan companies, they will anyways recover money because no one wants to get their house taken away by the lenders, right? And India is not such a country where we all have taken 2-3 houses on borrowing. I mean, we all are aspiring to take first house on borrowing only.
Right.
We have not reached that stage where we are already wealthy enough that we take 2 or 3 houses on lending like Europeans does.
Yeah.
Right.
So if your first house is there and you have taken EMI for that, very low chance that you will actually default in that EMI.
Yeah. And, just taking a step back, another theme that we have seen in the retail investors is an appetite for US equities, or overseas equities. Is that, is that something that StockEdge sort of operates in as well in terms of helping, retail investors make overseas investments? Is that something that's in your plan or, and what are your views generally of, this appetite that has come up recently?
I think it is, frankly speaking, I think it's overhyped.
Okay, yeah.
I think it's just adding glamour quotient right now because why will a retail investor invest in US equities after going through all these grinds of going approval from the bank and then sending money outside and all those things? India has too much opportunities available right now. Why will I invest in US equities? And if at all I want to invest in US equities, personally I would invest in mutual funds who are invested in core US equities.
Sure.
For example, Parag Parekh long-term fund, their 25% allocation is in US equities. And they have already invested in Amazon, Google, and other main companies where you would like to invest. And 75% allocation is in Indian equity. I will take that route rather than directly investing in US equities because it's very difficult for me to make a judgment on US stocks.
Yeah.
Let me just focus on making judgment on Indian stocks. And then if I feel that India doesn't give me that kind of an opportunity, then probably I'll go and think about investing in US equities. So today StockEdge doesn't have any plan, but who knows, after a few months or years, we find value there and we may get into it.
Yeah, and in the domestic, you obviously flagged your bullish views on the residential, market in terms of real estate. What are some of the other sectors that are, that you're watching closely, be it like, general FMCG or financials we talked about? But are there any other sectors that are, fascinating you right now?
I think overall financial market ecosystem is very exciting because the way new investors have come, and I believe this number will go up from 5 crore to 10 crores. So coming 4 to 5 years, companies which will deliver value to all these financial investors. So we know the liability side of an investor, which is the borrowing and lending side, which has been the theme for the last 4-5 years.
Yeah.
But I think the next level of theme is going to be on the asset side. And brokering firms or depository or exchanges, and there are many guys who are coming. CAMS is going to come out, their listing will happen, and then NSDL will come. So financial is going to be very, very exciting on the asset side. Okay.
Yeah.
And apart from that, I think FMCG is an evergreen story. You can continuously bank on a stock with a great FMCG portfolio. There's something like Dabur. Dabur, you can't go wrong with Dabur, right? When you are having every product of Dabur every day, literally, then you can't go wrong with that company. Something like, Pfizer probably, a quasi pharma FMCG company, or a Nestle. So these are expensive, but these are stories where you will not go wrong for a longer period of time.
And most of them probably carry a healthy dividend as well, right? I mean, we've seen a lot of FMCG companies give a fairly decent dividend yield as well.
I mean, coming to your personal philosophy, I mean, you kind of consider yourself to a trader still, you consider yourself to be an investor, you kind of follow a fundamental view, a technical view. I also saw that you have invested in a few algo trading companies. So is high frequency trading something that you keep very close to your heart, which definitely is kind of irons apart from the traditional framework that market participants often use. That is first part of my question. The second part is that during COVID, what kind of methodology or what kind of framework you use for screening opportunities? I mean, like, is it, I don't know, cash flow generation, low debt? Because I mean, in COVID, strange kind of, positions have come where sectors which we thought were untouchable, suddenly demand has pretty much disappeared. For them. So how do you advise a first-time investor, who wants to screen the 10-10-10? How do you screen the first 10?
Yeah. So to answer your question first, I'm a businessman, so I keep on identifying opportunities to do my business. So my trading desk, my algo desk, these are part of my business initiatives, which are like more evolving. And I keep on forward integrating my businesses.
Yeah.
Tomorrow, maybe I'll start my broking as well. I don't know. If there is a need of the business, I will do that. But the other part is, for me as a trader or as an investor, I'm no more a tick-by-tick trader, which I used to be earlier. Now I prefer to call myself an active investor.
Right.
So someone who doesn't believe in this theory of buy and hold. Okay. I believe that, what goes up has to come down. So you should be the first one to identify when the momentum is dying out. So you buy with an intention of selling, and the selling could be in 2 months to 2 years or whatever time frame. But I'm not someone who is into value investing. Okay, I'm more of a quant guy who wants to trade also with the same investment which I have done. Now to answer your second question, see. If you are a normal investor, see this cash from operation or return on equity, return on capital deployed, these are languages which we understand because we have been taught this. Okay, you also come from a financial market background. I come from it, so it's easier for us to screen stocks based on these terminologies. But a normal retail investor doesn't understand these things here. We have to understand because I deal with them. No, I understand at a ground level. Just go. 90% people don't know the essence of equity market, essence of a stock. For them, ये ₹2 का है, वोडाफोन ₹10 का है, सर सस्ता है. कहाँ आप रिलायंस दे लेने बोल रहे हैं ₹2100 का? This is the thought process of a normal investor. They will never understand the market capitalization. They will not understand that why Vodafone is ₹10 and why Reliance is ₹2000. Okay.
Sure. Yeah.
So what I suggest to them for core, absolutely raw retail investor who is coming into the market right now, these 10 stocks which you decide to invest in should be part of your circle of competence, which is what Warren Buffett also says, that it should be related to either your business, your occupation, or your product which you are consuming. Yes, most of them will be around consumption companies. Fine. There's no problem. At least you know that you as a consumer of a product, you will always have a first-hand feedback about that product. And I love Peter Lynch, the way he handles a company, the way he analyzes a company, visiting stores, figuring out whether things are selling or not. I think retail investor can only do that. Right. Running screeners, etc., is more of for a professional investors like you and me. And there you can have multiple criteria. I mean, obviously low debt, high cash from operation, and very high promoter stake. This is an evergreen screener.
Very high promoter stake. That's interesting.
Everyone wants to invest in companies which are low debt, very high cash from operation, and high promoter stake, because you know that there are limited stocks in the company, limited shares in the market. So with limited float, you obviously have a higher chance of stock prices moving up if the business is doing good. Yeah. Classic example is DMart. Classic example is IndiaMart. So these are companies where there are limited stocks in the market, limited shares in the market.
Right.
And if the business fundamental is good, these stock prices will continuously go up, no matter what expensive they become.
Yeah. No, that's sorry. Go ahead.
No, I mean the point of promoter stake is very interesting because it kind of goes very much against the Western construct where people generally prefer widely held companies, and there is like a kind of a segregation between principal and agent, whereas in India the dynamic is quite different. So that's fascinating to hear.
And
I think it's we are maturing as a society. Yeah. And I think right now we don't trust the promoter. So we just say that if promoter has the skin in the game, that's where we would like to also see.
Yeah.
But as we mature, we'll have more HDFC banks of the world where promoter stake will be very, very marginal. And largely owned institutions, ITC, largely owned institutions. There I think the mindset differs very, very significantly.
Yeah.
But they have a history. That's why.
Yeah.
And we talked about screening and how you identify companies, and everyone has their own philosophy, but very rarely do people talk about their selling discipline. Like buying discipline, I get, like people have frameworks, mental models, but for especially a person like you alluded to the fact of getting in and out of positions depending on how it's moved. What is your selling discipline like? Is it just a percentage number that if it's gone up by this much, then I can sell it and buy it back again? But how do you think about selling and unwinding positions?
I'll share a secret with you, okay?
Yeah.
And don't share this with anyone else.
Except for the ones who are tuned in.
Podcast is the perfect place to do that.
Well, I always look at the strength and the weakness of the stock vis-a-vis market index, nothing else.
Yeah.
Okay.
And I tell you, the most simple, most effective tool. If the stock is showing strength vis-a-vis the market, you keep on riding that stock. The moment the stock will start showing a weakness, you exit that stock. See, I have this theory that every stock has been managed by some operator. You may consider it to be a negative connotation that operator is generally used. Harshad Mehta was an operator. Ketan Parekh was an operator. It's generally used in a negative connotation. But that's not true. Every stock is operated by someone, right? It could be group of institutions. It could be promoter. It could be some individuals. They have very high stake in that company, or who are holding good number of shares in that company. So they will want that company stock price to behave in a certain way. There's nothing wrong with that. So let's call them operator. Now it is important for us to know whether in that stock there are bull operator or the bear operator. Sure. Whenever there is any bull operator, that stock price will outperform the market index. Whenever there is bear operator, the stock price will underperform the market index. Take a classic case of what is happening right now, ITC and Airtel.
Yeah.
They are massive bear operator in the market. And both the stock prices are underperforming the market index. But retail investor wants to buy it because they feel that these are the stocks, why are they available cheap? But the fact is there is enough bear in the market who doesn't want that stock to go up because they have a short position in that stock. So relative strength of a stock vis-a-vis the market index is the most simplest form of analysis to decide whether you want to stay invested in that stock or exit that stock.
Yeah. And is this a framework that is deployed in the analytics package at StockEdge, which is available for retail investors?
Yes. On the there is a scan called price scan, and inside the price scan we have designed relative strength scan. This is different from relative strength index, which is a technical indicator. Relative strength scan actually tries to identify the stocks which have strength vis-a-vis the market or weakness vis-a-vis the market. So we have made it very simple for people.
Yeah, no, that's fascinating. And Vivek, just to touch a little bit about StockEdge as well. I know your primary target focus is the retail investors, but is there any sort of plan or to target the institutional side? I mean, I understand that they're fairly well served with the Bloombergs and FactSets and Capital IQs of the world, but there's a general sense that those products are very heavy on US and European markets, but are light on the Indian front. So that seems like a market opportunity.
Super expensive.
And super expensive. Agreed. From an Indian currency standpoint, is that a market that you think can be tackled or addressed?
Frankly speaking, it's a very small market in India.
Okay.
A handful of institutional investors in India, and most of them are glued to Bloomberg. The reason why they are glued to Bloomberg is because it is not just the terminal Bloomberg, it's the community Bloomberg. It's the fact that I belong to a fraternity who is using Bloomberg. That ego, that fact that I can connect with anyone anytime because there is a direct link with that person available on Bloomberg, that itself is a powerful reason to subscribe to Bloomberg. I do a face-to-face series in my YouTube channel of Elon Markets, very similar to what we are doing right now. You should see that. Very impressive work there we are doing. So I recently interviewed a guy from Bloomberg called Akshay, and I'm going to make the video today live in that channel. And we were talking about the same thing, that why Bloomberg is expensive and for retail investors it's not possible to afford. And he was telling me that, Vivek, Bloomberg is actually the cheapest tool available in market. Why? Because if you know how to make money, you can make so much money in market by only subscribing to this small piece of cost which Bloomberg has. But obviously it's not for retail investors. For institution, there is no reason why our second product or the third product is needed. We already have Bloomberg, we have Reuters, we have one or two more guys from India who are trying to go up, like the ticker plant is there, which belongs to FT Group. But really they have not done great because the market is too small.
Right. And obviously one theme that you kind of touched upon was that amateurs know how, when to buy, but experts know when to sell. In terms of your overall read of the Indian retail investor, because you have been looking at this space for now, a fairly long time, how has the behavior changed, if it has? In the sense, do you now see the retail investor of 2020 to be more switched on, more plugged in, more clear? Obviously you guys must have also evolved your product over time. How have you seen that entire evolution pan out?
Well, I'm glad that you asked this question. Retail investor, what it was 2 years ago and what it is today is very different. This new retail investor crowd is questioning that why this stock should go up, why this stock should go down. I divide this whole financial market ecosystem in 3 phases. Okay, In fact, I just wrote this morning. I wrote in LinkedIn this particular article. First phase is from 1990 to 2010. This was a phase when there were around 50 lakh investors, and the brokers, which were like full service brokers like Motilal Oswals of the world, everyone were trying to make money from these 50 lakh investors by offering them research, by offering them everything so that they can feel empowered and they can trade based on their recommendations. From 2010 to 2020, which was the second phase of the market where discount brokers, they grew. And, they took a perfect advantage of technology and low cost to serve a particular category of new users. So that 50 lakh became to 1 crore or 1.5 to 2 crore max. But from 2021 onwards, we are going to see a massive change in this entire ecosystem by Paytm Money, Grow, and other kind of people who are from e-commerce background, who are coming into the market and selling people stocks as if they are selling mobile phone covers. So the whole ecosystem will change. Quality of investors will also change, and sensitiveness about market and knowledge about market will also change. So, to answer your question, is retail investor doing more homework, trying to be more inquisitive, learning more? I would say yes, vis-a-vis last 2 years. Coming 5 years, I see many investors now would be hands-on with what they are doing, because they will be using only platforms. For example, if you want to buy a mobile, you visit Amazon or Flipkart or anyone, but you just don't rely on their judgment, right? You also do your homework. You'll take probably 2 days to figure out which mobile phone is actually most suited for you. Same thing will happen in India. The whole financial market is getting converted into e-commerce in probably 5 years down the line. So the investor thought process will change significantly.
Yeah, I know. Hopefully that will also lead to like more democratization and another check on the overall, like when we were talking about regulatory interventions or market interventions, like just the fact that there is more plug and play options available at the retail level would also, kind of hopefully lead to more information symmetry.
Yeah, I know, and it's good to hear. I find it very hard to not insert our little the stuff that we do here. I mean, we are also have similar views. We are bullish in the space, and one area that we are targeting is content around finance. Right, the easiest way to sort of gain more knowledge is by reading and understanding. What role do you think content plays around it? Because there's a lot of emphasis being played on that as well, and that's something that we are seeing in the market as well. We work directly towards it. Our numbers of readers of our very finance and business leaning newsletter keeps going up. We keep getting feedback, engagement levels keep going up. So we are also seeing some very positive signs on that front. And what role do you think content plays in such an environment? Is that because you guys also put up like resources as well, right? So I guess that's one, in such a commoditized environment, the way to differentiate quickly becomes content and the tools that you can, in your case, analytics as well. But what role do you think content plays in such an environment?
Well, I think content is the enabler for this whole ecosystem. And all the erstwhile brokers, they've realized this, that they have missed the bus by not adding on more content for their existing users.
Yeah.
But the problem with content is that a video which we record as a learning video in our Elan markets. Previously, we used to think that this is for 3-year period, and we'll have to change the format of that video after 3 years. But now we are thinking that this has now reduced to 1 year, because the way you deliver, the output which you are generating, the modus operandi of delivery, which will excite the audience, is changing so dynamically.
Yeah.
So the same content, a 6-minute, 7-minute content, which was very, very relevant and superb almost 2 years ago, today it looks like a pale and not so relevant content. So today I am creating content which should be 30 seconds, 40-second content.
Yeah.
A 6-minute, 7-minute content is actually no more relevant in the market. Second, the problem with content is that so in mature market, people realize the value of content and they are ready to pay money for the valuable content. In India, somehow people in India still don't value content so much. So you need to make money indirectly through transaction. You're getting my point? If you see all these media companies like say ET or the Ken, so they are trying to incorporate subscription plan around the content, but these are very early days. We don't know whether in India the mindset shift will happen and people will be okay with multiple subscription to multiple neutral contents. Right? So what is happening today, if I have to monetize that content, because you know that how effortful it is to develop a content, right? Today, if I have to monetize it, can a user directly pay for my content? I would say today India is not ready for that. Maybe 1 year, 2 year down the line, we will be a mature nation and we'll be ready for that. But today you have to make money indirectly. And that can only happen once you facilitate transaction. So if you ask people to open an account with a broking firm, give an affiliate link below this video, and you share some brokerage which the client will generate by trading through that broking firm, that's acceptable. But you ask people to contribute 100 rupees for a content because it's a good quality content, India is still immature in that sense.
Oh, fair enough. And, just wanted to get a quick take on StockEdge in terms of you as a business operator. What is the next step in terms of taking StockEdge to the next level? Is it just broader, deeper, more analytics and more data points? Is it growing into, growing deeper into the markets in terms of expanding your retail base? How do you think about your business strategy?
So my strategy is that we need to go deeper in terms of the content, in terms of relevance of the content for our users. And we also need to get deeper inside each and every user. Until a user actually gets some decision-making output from us for his or her respective market participation. So you may be a trader and you may be a swing trader, or someone may be an investor. So the role of StockEdge should be to identify who you are and accordingly give you a ready-made solution based on your requirements. That engine development is in progress. So we have data. We have data with respect to user. We have data with respect to companies. Now we are clubbing everything and planning to come out with a ready-made solution for each individual users.
And does retail brokerage fascinate you?
It does fascinate. It does because it's very exciting. Although I've never been into the retail brokerage side, as I've always been on the trading side. So I know how to make money from myself. I don't know how will I help other people to make money as a broker.
Fair enough.
But it's very fascinating. You actually can connect with so many people and then provide them relevant tools. What Zerodha has created is very, very exciting. The way he has kind of established everything and the way the whole ecosystem has built is very exciting. But as I say that this whole broking business will be so commoditized after these e-commerce giants becoming big that it will not be no more a kind of a very exciting business proposition to only having a broker service. Then anyone with an entire ecosystem that from the same customer you are making certain rupees by doing this, certain rupees by doing this, which is the e-com mentality. If you have that entire ecosystem, then you will become very big. Otherwise, it's good to be a niche player, catering to only limited number of clients, but making a good ARPU from those limited number of clients.
Sure.
I mean, that kind of I think is a great summary because it was only a few days back when we were discussing how big tech entered payments in India, and then the government entered payments, cannibalized the entire business model, and now they are all looking at how to cross-sell and distribute financial products and services. So that theme kind of plays well in terms of how broking might kind of become like another cog in their wheel as a commoditized offering. No, listen, Vivek, this was a very fascinating chat, and we have now almost hit 50 minutes. So it was longer than our usual conversations, but that's the beauty of podcasts. It's probably the only multimedia long form format out there. So we like to take full advantage of it. Thanks a lot for your time and for your insights, and all the best for StockEdge and your other projects. Wish you a very great day and good luck. And how was that, Sharad, for today's podcast? What do you think?
Yeah, no, it was fascinating and appreciate the time you take out. Like a lot of interesting chatter for our listeners as well. And we obviously thoroughly enjoyed being on it.
Great, great. Thank you, guys. Best of luck for your endeavors. Keep developing good content. India really needs it. And but obviously, also figure out how do you keep the growth momentum on with these contents.
This is a good theme for the next episode.
Yeah.
I mean, this is like a dedicated theme in itself. How to monetize content. But no, thanks a lot.
Yeah.
This was great. And with that, I think we'll return soon. Yeah, this is Nikhil Arora
This is Sharad Tupran.
signing off.